that I don't think any of us have ever seen before, and it's difficult to prognosticate on it and be able to predict accurately how this is all going to play out. I think, Tom and I probably share this experience. In early March, I was in Las Vegas giving a presentation. It seems like 10 years ago now. And one of the questions I got after the presentation is, well, why would I care about guaranteed lifetime income when I can get guaranteed income from my real estate investment that's going to pay me, 6 or 7% on my investment? And what we've seen right now is in many cases, the realization of the risk that's involved in getting income from a source that is not necessarily a guaranteed income source. Mall rents have gone down by over 50% over the last month. A lot of small business owners are obviously struggling with cash flow. I know a financial advisor near me who had a client who had a $40 million portfolio of hotels. And what is the value of that? I have neighbors. I live in West Texas. What is the value of businesses that cater to the oil drilling industry in West Texas? Many of them had a net worth that was over $10 million, and now nobody knows what the value of their net worth is. The ability to draw from assets that provide an income or wealth in a time of need has never been higher. And I think it's one of the reasons why you've seen record inflows into insurance products over the last couple of months. This has been a great time. So let me just talk a little bit about the macro economy and what's going on. I think what we see is that there are a lot of industries that are suffering significantly. If you look at the bond market and the commodities market, you're going to see, and those are generally pessimistic markets to start out with, but they show a level of pessimism that's not necessarily shown to the same degree in the stock market. Nobody knows when cash flow is going to get back to normal. I mean, it may be the fall, it may be next year, but I think nobody thinks that the world is going to be the same 6 months from now as it was 2 months ago. It's a world with different risks. It's a world where we value security and safety more than we have in the past. And I think that there are also, before I end, I want to talk a little bit about the risks to the insurance industry as well, because I think we have to be very honest about the range of risks that are faced by different segments of the economy. In the insurance industry, a lot of the value that they have been able to provide to clients comes in the form of guarantees. And those guarantees may be a guaranteed interest rate, a guaranteed withdrawal benefit. Those come from investments in bonds, and they come from hedging products like options. And options are obviously a lot more expensive when there's a lot of market volatility. So some of the cost of being able to maintain and offer some of those products has gone up. But again, because those costs have gone up, the value to those who have purchased those products is even greater. And also there seems to have been among some insurance companies a flood of money into higher yield bonds, especially over the last year and a half or so. So I think there's a little bit of struggling, especially among the weaker insurance companies, a greater demand or a greater value placed on insurance companies that have a stable, secure balance sheet. And I think, I haven't heard any client say that they regret buying any product that insured against the bad times recently. What I've heard from advisors is that if they integrated a growth strategy with some sort of protection strategy, these are the times to focus on the value of that type of an integrated strategy. But I think none of us know what the future holds, and there's never been greater demand for security than there is right now. Tom, don't you think so?
I agree, Dr. Finken. These are uncertain times. And what I say is when there's uncertainty, people crave certainty. And that's what our industry can bring, is certainty in uncertain times. I can't tell you if the market's going to go up. It could go up 50% from here. It could go down 50% from here, which I think is a perfect reason why somebody should use an annuity, where they got downside protection, but they can still have upside potential. The one thing that I do say is that interest rates are going to stay very low for a very long period of time. So a lot of people think, well, we've printed so much money, And traditionally, when you print money, it causes inflation. You know, Milton Friedman said inflation is always and everywhere a monetary event, which means if you print money, it will cause inflation. But we're not seeing any inflation. Japan's printed more than we have. They're fighting deflation. China's printed more than we have. You know, I think it's interesting because Harry Dent, who I don't agree with on everything, but on the big macro things, he gets a lot of things right. You know, he said inflation is a demographic issue, that young countries experience inflation and older countries experience deflation. And I think we're going to be experiencing deflationary pressures for the long period of time. And I always say, I can't predict interest rates, but the bond market does. It does it every day. And right now, the 30-year government bond is like at 1.3%. So what is that telling you? The bond market is telling you interest rates are going to stay low for a very long period of time. Dr. Finke just posted today on Twitter that the 30-year TIPS bond has been negative for 25 days in a row. And so what I'm telling you is the market is telling you interest rates are going to stay very low for the same reasons I've been saying it since 2011. You know, there's massive government debt, and all debt is taking from the future and spending it today. And so what we're doing is we're reducing our potential in the future with all of this debt. When people are in debt or governments are in debt, eventually they have to deleverage. And how do governments deleverage? They raise taxes, they cut spending, both of which are highly deflationary. It reduces growth, it strangles growth. And then there's demographics, that we're getting old, Europe is old, Japan is very, very old, and old people don't spend any money. And so you've got all these deflationary pressures that are going to continue. So I think interest rates are going to stay low for a very, very, very long time. Just watch the 30-year bond. If you see the 30-year bond start going up to 3 and 4 and 5%, then you can start worrying about interest rates. But I'm not there yet. You know, what does this mean for investors, business owners, employees? I think one of the biggest lessons coming out of this is that everybody needs an emergency fund. Businesses need an emergency fund too, and 3 months is not enough. They've got to have 6 to 12 to 18 months in a safe place, which is a perfect place for permanent life insurance. They can have life insurance coverage. They've got an emergency source of funding if they need it. And I think individuals and businesses need to look at having more savings that they can tap into, because I promise you, this won't be the last crisis. Now, any little virus anywhere is going to the media will blow it out of proportion, and we're probably going to be in lockdown multiple times over the next 20 years. I mean, it could get to be ridiculous. So anyway, I know we're tight on time, so I'm going to turn it back over to Angela.
All right. Did you guys want to comment on the next question? Tom, if you want to start the next ones off. Or are we good on this slide?
Yeah, I think we're good on this slide.
Yeah, let me just make one more point, and Tom sort of alluded to it, and that is that if you have wealth that's held in a general account portfolio indirectly of an insurance company, that cash value is not marked to market. And we saw, you know, a lot of general account portfolios are invested in intermediate term corporate bonds. Those went down by 20% in March. That's something we've never seen happen. And if you held a balanced portfolio that consisted of equities and intermediate term bonds, you saw your success rate on your investment portfolio go from maybe 95% down to 66%. If you had held instead that part of your intermediate term bond portfolio in cash value, then your success rate would still be in the mid 80% range. So holding a bond portfolio that is not marked to market, where the insurance company bears some of that risk, where you can look at your immediate accessible cash value and it is not fallen in value, even when the corporate bond market has fallen in value, that I think is an underappreciated source of safety in what should be a component of your safe investments anyway.
And one other thing, they say diversification works until you need it. And when times got really bad, what you saw is everything went down. Stocks went down, bonds went down, oil went down, gas went down, gold went down. Everything went down at the same time. And that's why life insurance and annuities that have some guarantees, those are totally non-correlated assets that do have a place in a portfolio.
All right. That was awesome. Okay. Buyer behavior. So, Tom, why don't you start us off for this slide? How has this affected the psyche of the average investor?
Well, I mean, of course, they're all concerned, and the people of money in the stock market, a lot of them, panicked and sold. And I always get a kick out of all these financial advisors that are assets under management people, and they say, oh, my people don't panic. My people stay the course. My people are in it for the long haul. Oh, yeah, what just happened? When the market falls 40%, I don't care who you are. People start picking up the phone and they say, get me out. And they get out at exactly the wrong time. And then they don't get back in to ride it back up. And that's the problem. It's investor behavior that is more of a problem. Investing for the long term, dollar cost averaging, that can work over the long term. But what happens is investor behavior kicks in and they do all the wrong things. So, what should people be thinking about? I think they should be thinking that they should have some money in guarantees, especially people in their 50s, 60s, and 70s. See, here's the problem. People have been taught that markets go up and markets go down, but over time they always go up. Well, that works when you're in your 20s and 30s. You can close your eyes, you dollar cost average in the market. You wake up on your 65th birthday, you're rich. But it doesn't work when you're in your 60s, 70s, 50s, 60s, and 70s because it is no longer dollar cost averaging. It is now dollar cost ravaging. Because let's say somebody doesn't believe in annuities or life insurance, they have their money in a diversified portfolio, they're taking money out. Well, that works as long as the market's going up. But as soon as the market starts going down, they got to take out more and more and more. And when the market goes back up, then that goes back because they took it out and spent it. And all it takes is a couple of those dips early in retirement when their portfolio can enter a death spiral. The other thing people don't get about this sequence of returns that Dr. Finkel was talking about is they say, well, you know what, I'm just going to wait it out. I don't panic. It always comes back. Well, back in the 1980s, the Japanese stock market was hitting all-time record highs for about 10 years. It was kind of like what we just went through. There were companies like Honda and Toyota. They bought Pebble Beach. They bought Rockefeller Center. Japan said Japan is taking over the world. That was the 1980s. So you got this 65-year-old Japanese guy, got a diversified portfolio. He retires, starts taking money out of his portfolio. In 1989, the Japanese stock market crashed. The Japanese stock market has been down now for over 30 years. The poor guy's 95. The market never came back. How do you think his retirement went? The European stock market has been down for over 20 years. Emerging markets have been down for over 10 years. I am telling you, Americans have no idea how far the market can fall and how long it can stay down for. And that's really the problem. And as far as things changing in the industry, they're going to have to change products. There's only so much interest rates that are out there. There's option prices went up, and so products are going to have to change. But there will still be permanent life insurance. There will still be annuities, and there will still be, a robust industry. And when people think the payout rates today are low, I say compared to what? Compared to a 10-year at 60 basis points? I'll turn it over to Van now, I think.
Wow, thanks. What's very interesting, everybody keeps thinking that COVID-19 caused all of this, and it really didn't. COVID-19 really just uncovered all of this. If you take a look at cheesecake factories, there's 300 of them in the United States, and there are 20,000 subways. There are more subways than there are McDonald's. There's only 14,000 McDonald's in the United States. Here's the deal. The reason I picked those two companies is that they're part of the same group. And neither of those companies were able to pay their mortgage in April. Not one single location was able to pay their April mortgage. So Warren Buffett said a great line. I don't really mess around with this too much because, like Tom says, I agree with him. None of us really knows what's going on. And anybody who thinks they understand the stock market anymore, the stock market is fake. It's not real. It's manipulated by all kinds of things that we don't have access to or information of. And Warren Buffett summed it up wonderfully. I say to all my customers, they say, do you know what he said about this? He says, it's really interesting what's currently happening in our world. He says, think about it this way. When the tide goes out, you really get to see everybody who's been swimming around naked. It's a very, very important understanding that none of us really knows what's happening. And so what's terrifying to our customers is that they don't understand why this happened. They don't understand why in America they're hungry, and they don't understand why they're losing their job. They don't understand any of this. And so I think it's very, very important for us to not tell anybody anything, but ask them, what if there was a way that the next time this happened, you wouldn't have to worry about it? What if you could be in control of it? What if you could take advantage of it? What if you could use your dollars that you have more efficiently and more effectively? What if you could use the same dollars that you're using to build financial and retirement benefits to also protect you at the same time? What if you had really effective and efficient dollars? Would you want to know how to use those? And if you're really paying attention the way I'm talking about this, I'm not talking about an interest rate, because I agree with everything that's being said here. I think we're going to have another lost decade as far as the stock market. I believe interest rates are going to stay low for a very long time. So I'm not promising my customers that I'm going to make them anything. As I wrote in my newsletter, what I'm very proud of is I have no equal when it comes to protecting your money. And that's my responsibility, and that's my job to you.
Tom, any last comments, or should we move on?
You can move on.
All right, perfect. Our role in the pandemic. John, why don't you start us off with this one? How can we help clients weather the storm? We can't
John,
hear you,
you're
John.
muted. You're muted, John.
I'm good now. I think the best way that we can help clients weather the storm is, first of all, let them know that we're there for them. But this is not the time to hide. This is the time to be there and to show support and to help clients be aware that those that have done proper planning are going to be able to weather the storm. Those that didn't take advantage, as Van indicated, of how would you want to be prepared better for next time. You know, the bottom line of it is, if we're going to help somebody weather the storm, they have to have the wherewithal to be able to do that. You know, insurance is a lot like religion. You have to get it when you think you don't want it, to have it when you really need it. So at the end of the day, it's not about rate of return. It's not about interest rates. It's about having the accessibility to funds when you need them, the sustainability of funds when you need them, as well as, you know, the flexibility to be able to take advantage of things as they come along. So in helping clients weather the storm is helping them to realize what most people already know but don't want to think about. You know, everybody wants to believe that the world's going to be better every day and every day. Market's going to come back, which in time I believe it will too. But the thing of it is, as we all preach and teach every day to our clients, the bottom line of it is you need money when you need it. You need reliability and you need sustainability. And that's where the non-correlated assets using certain types of permanent life insurance and annuities can help do that. And in addition to that, have your clients think about, look, if a temporary issue like this caused financial stress, what would happen if, in fact, it was more lengthy or more serious than this? You know, how long could you go without a paycheck without being a problem? How much volatility could you really handle? When you're having to sell at a loss, you never get that back. So the sustainability and helping people to realize and be able to reflect in times like these is really important, because oftentimes we don't think about the things that really matter until there's a crisis. And no crisis should go without some reflection, because how could we have done something different to where things would be better for us?
And I look at our role, it really started before the crisis. Because if your clients are panicking right now, you did not do your job. Plain and simple. So you have to look in the mirror if you got a lot of clients that makes you want to run and hide. Just to give you my own experience, I had 2 clients call so far that were nervous about the market. I had numerous calls where they said, is it time to put more money in? So they're getting it. And, you know, you got to look at stocks and bonds. They're a commodity. Everybody's got one, right? And if you look, I see a lot of advisors that are picking and choosing and managing their clients' portfolios, which I don't think that's their best role. Their best role is the relationship management, educating their clients. You should be delegating that to the people who have all the research. At least that's my opinion. I've seen statistics that as many as 85% of fund managers don't beat the market, and all these people have this special proprietary way of investing. And yet, if you look at over a 10-year period, the difference from one portfolio to another becomes quite small because it is a competitive world. If someone's not making the grade, they'll be replaced. So the thing is, we need to be educating our clients ahead of time about what the worst case scenario is and what our strategy is for dealing with it. And I'm a huge believer in buy income, invest the difference. All my clients are sleeping well. As a matter of fact, we had a client, it was really interesting. They wanted to wait until their advisor retired because they didn't want to offend him. Okay, and he said, he'll probably be retiring in 2 or 3 years. I said, so let me understand this. You're going to put off your retirement till your guy retires? Does that make any sense? And he goes, well, when you put it that way, I said, look, you're retiring now. You need a retirement plan. He had all his money invested in the market. And we literally moved his money in February at the peak of the market. Now, we didn't take all the money out of the market, but we just segregated some of the money into the guaranteed income products that were in alignment with the income that he was going to need, along with some tax strategies to take advantage of Roth conversions right now and other things. And, he called me up not so long ago, and I literally just helped with the planning process. I was in 1 or 2 meetings. I have a junior advisor here that's only been working with me for about 2 years as an advisor. And he actually called him and said, I want Jim to call me. And I'm really nervous that he's feeling like he just got passed off and he's going to give me an earful. And actually, he spent a half an hour complimenting the job that he did, and he felt, because he used to be a supervisor in his line of work, which he was a mason. He said, I know how hard it is to get your team to work well with you. And he says, as well and as comfortable as I am, it must be a testament to what you're doing. And I bring it all back to people like Tom Hegna, Curtis Cloak, and Michael Finke, and Moshe Molesky, who were beating it in my head. The last downturn where I thought there was no safe harbor, this one was even worse than the last downturn as far as when you see everybody unemployed at the same time. If we haven't prepared our clients, then shame on us. So for those of you that maybe have a lot of clients calling, you need to take the time to reflect. I mean, we really are our client's financial coach. We're not anything special. We're not a guru in predicting the markets. None of us have a crystal ball. But if we look at history, I always say, you look at the Bible in the Old Testament, 7 years of feast, 7 years of famine. Nothing's changed. Although now we have the media 24/7 talking about how the sky is falling and we're all in trouble. There's some opportunities there right now. And that's what our role is to help people stay focused on what's important. And it's not a one-size-fits-all. It all depends on the client. I had somebody tell me, geez, at 70 years old, should they have 80% in the stock market? Well, if they don't need the money, yeah, that's okay. Because if they got a 10-year or better time horizon, that's fine for that portion of money. But the other portion for the next 10 years, we better make sure that's outside the area of having the volatility risk, the sequence of returns risk, and there's no better product than the stuff we have in the toolbox.
John, comments, or should we move forward?
I think that's where we have to really get back to the consequences that people are going to deal with if their plan doesn't work. Who's going to be affected? How are they going to be affected? How's their lifestyle going to be affected? It's not about rate of return. It's not about interest rates. It's about stability and security. And if you can still buy that loaf of bread, whatever a loaf of bread costs, that's the key. So we've got to find out, first of all, what our clients' goals and dreams are and what the consequences are if their plan, whatever their plan is, doesn't work, and help them think through it and talk through it and provide that security.
All right. Importance of communication. What's important to communicate to our clients? What should we leave off the table? How do we address clients' Should we be using social media, Dan?
Well, if I can, please, this is an editorial about social media and Zoom. I think everybody's already going through Zoom fatigue. The thing that's very interesting to me is if you're not engaging in person, you're certainly not going to be that engaging on Zoom or GoToMeeting or on the telephone. So what we need to do is work really, really hard at asking questions that inspire our customers to take action. This is very important. This is the greatest time ever to sell cash value life insurance. For the first time ever in the history of the business, if you sell cash value life insurance, you're the competition. And it's what's really funny is the only people who don't seem to know that are life insurance agents. It's distressing to me. So the way that I've tried to work very hard with my customers, prospects, and clients is to simplify the message by asking great questions. I'll give you a couple of examples here really quick, because I don't want to take a lot of time. We have so many amazing people, but I'm a salesperson. I'm 30 years in a row, top of the table. My job is not to teach people things. My job is to inspire people to take action. And you can't do that by complication. You must do it by simplification. So here's a couple of great questions that you can talk to people about. First, you ask them, you say, can I ask you something? Pretend you don't know anything about finance. You don't know anything about income taxes. You don't know anything about economics, nothing. Okay, well, you just pretend that for a minute. Then you look at them and you say, based on everything that you've seen happen in the last 90 days, do you think it's probable that the governments of our country are going to need more revenue in the future? Most of the time, my customers laugh. And they say, well, of course. I said, well, then can you tell me, does it make sense to, when we have historically low income tax rates, to take a tax deduction now on a small amount of money and build it into a gigantic amount of money that the government will assuredly come and ask you for down the road? Does that make sense? Or would it be better to pay your taxes now and send a whole bunch of money to the future that the government could never get their hands on ever again? Which do you think would be best for you and your family and your business? I don't tell them, I ask them. And I let them reason out what's the best. Here's another one. It's very important that we ask people this. I think one of the really important opportunities of all time right now is concerning long-term care. And I look at my customer and I say, can I ask you something? If there was somebody that you loved based on everything that you've heard in the last 90 days, would you be willing to put them in a nursing home? and they really, emotionally, they almost start grabbing you. No, I wouldn't put them in a nursing home. Well, then, so what's your plan to make sure that you can be okay, you can take care of them in your home? What if your long-term care policy doesn't cover you at home? What if you don't have a rider that covers you at home? What if there was a way we could build a big pile of money in cash value life insurance policy? You could use that money to pay for long-term care in your own home. And I have a surprise for you. The day you die, the death benefit would replenish the asset for your family. And I have a better surprise for you. If you never needed the benefit, you wouldn't have wasted 1 cent of premium on the coverage. Now, in a world where we're going to have less and less discretionary money, wouldn't it be important, first of all, to have more effective dollars than fully taxable dollars? That's first. And second of all, wouldn't it be amazing if we could show America a dollar where they could save for the future, save for retirement, but at the same time have the protection they need if they had a critical illness like a heart attack, stroke, or cancer? So this is I'm not going to talk a lot the rest of the thing, but I want to just leave this. This is the questions that I ask every customer. I don't tell them what they want. I ask them, would you like these as benefits? Here's the first question. This will take 2 minutes. Then I'll be done. If there was a way for you to never lose any money ever again, would you be interested in finding out how to do that? Yes. Second, what if every time something bad happened and you didn't lose money, you would have access to that money to take advantage of what happened. Would that be beneficial? Yes. Third, what if you could do that with reduced or total elimination of your income tax liability? Would that be beneficial? Yes. Fourth, what if you could use these same dollars if you had a critical illness like a heart attack, stroke, or cancer? You could use some of the values inside of this program to transition your life so your life wouldn't be destroyed, and when you died, what you used while you were alive would be replenished for your family, your business, or your charity. And fifth, if you end up in the nursing home, what if you could use most of the values while you were alive, and the day you died, the death benefit would replenish the value for your family, your business, or your charity? But here's the best surprise of all. On those last two that I just talked to you about, what if you never needed it? You wouldn't have wasted 1 cent of money on that benefit, even though you had it available to you. And last but not least, what if when you get to retirement, you could establish an income tax-free cash flow that you could use to supplement whatever retirement you have? Wouldn't that be the most effective and efficient use of the money that you could ever do? And I have one last question, and then I'll never bother you again, I promise. Can you tell me, do you know anything else in the world that can do what I just described? And when we teach it to agents, I ask them, what did I just describe? And the answer, very simply, is a cash value life insurance policy. I don't care what kind it is. As long as it's a cash value life insurance policy, if you don't over illustrate it, if you show what it does rather than what it is the greatest time to be a life insurance agent.
John.
I agree totally that it's all about the questions. You know, the issue is if you don't know where you're going, how can you be sure you're not already there, as the great philosopher Yogi Berra said. So at the end of the day, sometimes salespeople have a tendency of getting ahead of themselves, and they think about what they're there to sell or their product is the best and so on and so forth. And it just depends upon how the client can view it. And if they can't understand what it does, it doesn't matter. They have to know what it does, how that's going to help their situation, how it's going to help them to achieve their goals, and so on and so forth, before it matters. And, you know, as far as social media and virtual tools are concerned, you know, many of us have been thrown into using it even more than we normally did. But I also agree that if you can't communicate with a client face-to-face, it doesn't matter if you're face-to-face on a computer, you've got the same challenges. You know, God gave us 2 eyes, 2 ears, and 1 mouth. We ought to use them in that proportion. If we ask more questions, listen to the way the clients respond, and observe how they react to certain things, then before we start prescribing anything, we need to have the proper type of diagnosis. Because at the end of the day, no one complains about guarantees when times get bad. And the thing of it is, again, if all we concentrate on is rate of return and interest rates, when things are good, they're very, very good, and when they're bad, they're horrid. But guarantees are still there. If I have a guaranteed cash value life insurance contract, that guarantee never went down. It doesn't matter what happens in the future, that guarantee is still going to continue to increase in the proper type of contract. So it's all about how much risk can you afford to accept, and how secure are you to achieve the goals and objectives that you want. And I think long-term care is probably one of the most overlooked situations there is. You know, if you look at the effects of not having proper program in place to handle the effects of long-term care, or as I call it, extended care, at the end of the day, that can be much more catastrophic than any market adjustment that you've ever seen. So you've got to have stability of income. You've got to have enough income to do what you want. You've got to have the risk transferred away that can be absolutely catastrophic. And you've got to know what your goals and objectives are. If you have legacy desires in particular, nothing can outperform life insurance. If you look in the terms of absolute rate of return, if you lock in a cost as opposed to being able to get priced out, because term insurance is called that for a reason, because there is a term that you're going to pay more in premium than you're ever going to get in death benefit. So unless you cooperate and die early, it's always a very expensive proposition. But oftentimes early on, we have champagne neat in the beer pocketbook. We have a lot more need than what we can afford, and that's when term insurance fills the gap totally. And the bottom line of it is, the most important statistic about term insurance of all is 100% of the term insurance policies never written are never converted. When I can get the policy prevention department out of the way, called underwriting, for at least a period of time, then I have an option that I know what the cost is. And I agree, from an economic side, in a low interest rate environment, we're going to see changes in the future on products that we have to offer. And, at the time that we could write annuities, fixed annuities that had a 5.5% guaranteed minimum, nobody wanted them because the bargain was in the market. You're getting double-digit rates of return. How's that look now? So you have to get things sometimes when you think you don't want them to have that non-correlated flexibility in the guarantees, where then you can access that, and then when they're yelling, I'm selling, and when they're crying, I'm buying. I can buy on sale, and that makes my market investments much better.
Awesome. All right, questions to ask clients. We kind of covered this, but Tom, why don't you take the lead on this one?
Well, why don't you just call them up and ask them how they're doing? I had a lot of widows when I was an advisor, and I would be calling them up now and saying, hey, can I stop by and bring you some milk? Can I bring you some orange juice? What do you need? This is a time to deepen the relationship, because I can tell you the brokers aren't calling them. You know why they're called brokers, right? Because they're broker than they were 3 months ago, okay? So the brokers are on the sideline. They're not calling their people. We should be calling. We should be doing annual reviews. I said all of the anti-annuity dominoes are falling. People say, I don't need annuity, I got real estate. Well, now renters aren't paying rent and landlords can't evict them. They said, I'm doing laddered bond portfolio. Yeah, how's that working when, the 10-year treasury's at 60 basis points? People said, dividend paying stocks, that's what I'm doing. Oh yeah, how's that looking? Every day you read the paper, they're getting cut, they're getting slashed, they're getting eliminated, and then, municipal bonds, tax-free bonds, that's what I'm doing. Well, Barry's just had an article that all these towns and cities are now defaulting on their bonds. So this is the perfect time to talk about permanent life insurance and annuities. I mentioned in a previous webinar that Dr. Moshe Milevsky, who's a friend of all of ours on the panel, he wrote a book called Are You a Stock or Are You a Bond? And that'd be a great question to ask your client. Are you a stock or a bond? And they say, what do you mean? Well, if you've got income coming in through all this, and you're paying your bills, and everything's just fine, you're more like a bond. And maybe you can invest a little more aggressively. But if your business is getting wiped out and you don't have a paycheck coming in and everything seems to be falling apart, you're more like a stock. And that means in your investment portfolio, you need to have some safety, some security, some guarantees. I think that's a great non-threatening question to ask your clients. Hey, do you think you're a stock or a bond? And then another great one that Van said, where do you think taxes are going from here? I mean, this is not a Republican issue or Democrat issue. This is a math problem. Hey, we need a math party. We need a party that can add and subtract. Because I'm telling you, you look at the math, we went from 22 trillion in debt to 25 trillion almost overnight. We have 200 trillion of unfunded obligations for Social Security, Medicare, Medicaid, military pensions, government pensions. Taxes have to go up. And that's why you should take advantage right now to talk to all of your clients about converting to Roth IRAs and talk to them about permanent life insurance so that they can start building some tax-free income in the future. They've got a 401k, but what most Americans don't realize is they got a partner in that 401k, and the partner is a federal government, and you have no idea, none, how much that 401k is actually going to give you in retirement, because your partner can take as big a slice as he wants to when it's time for you to retire. And that's not what I'm going to do for my retirement. So I have shifted almost all of my qualified money into Roth, and I've been shifting my new savings into permanent life insurance because I believe the tax savings are going to be far more important to me than whatever the market may or may not do.
I totally agree. Real quick again, because we're trying to help everybody get more appointments and take care of their customers. This is for property and casualty or multi-line agents, for Medicare supplement agents, and for everybody who wants to stay in touch with their book. I just call up everybody. I've done it with all of my clients. I've been working on it for almost the whole 3 months. I call them on the phone. I say, hi, this is Van. I just wanted to ask you, do you need anything? Are you okay? Is there anything you need to explain? Something you don't understand? And I said, this is really important. I want to thank you. I don't think I've thanked you enough for your loyalty and how wonderful you've been. And the only way I know how to say thank you to you is if you'd allow me to visit with you either on the phone or on social media or in person. And I would like to share with you just a few things that I think would really help you clarify in your own mind how you could be on top of this. And I'll even tell you what the questions will be before I come. The first question will be, are you aware of how serious this is and how bad this could get and all the challenges that you face? And second, what if you never had to worry about any of that stuff anymore? What if you had a strategy in place that would prevent you from having to ever be harmed by any of this? And the most important thing, the part that I don't think I've done a good enough job, see, I call it being a little self-deprecating, falling on your sword a little bit. I say to them, I don't think I've done a good enough job of this. What if there was actually a way to take advantage of all of this? Wouldn't that be amazing? See, in our country, people don't buy bad news. People buy access to opportunity. And we have one of the greatest opportunities of all time to show people that they can get control. That's a big mother of a word. People feel like they've lost control of what's happening in their lives. And I say to them, what if all you had to do is have this conversation with me and you could get control of everything that happens going forward? Wouldn't that be better? And wouldn't that be interesting? And when would you want to know it, before or after the next occurrence? And it's a great way for a Medicare supplement or a health insurance agent to show that they do something other than that. It's a great way for a multi-line agent to say, hey, I'm asking you some questions that I'll bet you your financial advisors aren't even asking you. And it's a great way for us to stay in touch and show the value that we can bring to them, and that we do care enough to pick up the phone and say, hey, can we be of service to you? I think it's the opportunity of a lifetime, and I just can't even tell you how much I adore what I do right now. So try it. It'll work.
And Angela, I would add that, in this thing, how can we position this crisis as an opportunity? Right before the market crash, I put out a video why every investor needs an annuity now. And I said the market had been going up for 11 years in a row. If there's ever a time you want to put some protection, it's right now. Well, a lot of people didn't do it. Well, 3 weeks later, the market crashed. Well, then everybody starts watching this. They start listening to it. So the point is, people don't do things when they should do it. They do it, after they should do it. But that's what we got to do. We got to go out and talk to them now, because we can protect them from the next crisis. And I know, Jim, you want to pipe in here too a little bit.
Well, I'm ready for the next slide, but there is one thing. I use this analogy all the time, and I think most people remember Kmart and the blue light specials. And I always tell the clients, I said, look, if you did shopping at Kmart or if you invested in the market or shopped at Kmart the same way, you'd be hauled away in a straitjacket. And I just use the analogy. Let's say the wife here, she needs a blouse. There's a wedding later this afternoon, and she's just going to run into Kmart, get a quick blouse, and get out of there. And as she's walking in the store, she hears that voice come over the PA. Attention Kmart shoppers, attention Kmart shoppers. For the next 20 minutes in the ladies apparel section, everything is 50% off. And you go into a panic because you never buy things when they're down. So you ask to speak to the manager, and you get the manager on there and say, look, I'm late already. I don't have 20 minutes to wait for this blue light special to end. And, I never pay for anything when it's down. Is there a way that you could actually make it full price? And actually, better yet, could you mark it up a little bit? Because I like to buy things when they're high. And if that's the way you shop, they'd all haul you away in a straitjacket. But that's the way people invest in the market. And I love your line. When they're yelling, I'm selling. When they're crying, I'm buying. There's no better way to put it. So, but at any rate, yeah, and that goes back to earlier when we talked about when was the time to be really talking to your clients. It was before this happened. Right? Be proactive, not reactionary.
All right, perfect. And then the opportunities, Jim, why don't you take the lead? How do we help clients move forward? What are the opportunities you see now and coming soon?
So I agree with Van this is the greatest time to be in the business, and not just the life insurance business. It's in the financial planning business, the insurance planning, the retirement planning. You know, what's interesting is we're an essential business. We got to start acting like we're essential. Be proud of the fact that you're essential. And I'll just touch on a couple things. I think we have the greatest opportunity ever, no matter what you're doing in this business. And one thing that I've learned is I've been technologically challenged my whole life. I've resisted technology, but I realized a couple years ago that I needed to either move forward or fall behind. So I made a tremendous investment in technology, even to the point that we could do video teleconferencing, even though I was totally uncomfortable with it and didn't want to do it. And fortunately, that was a couple years ago, and we were just kind of putting the finishing touches on getting everybody trained and up to date on all the things that we're able to do. And all of a sudden this hit, and I will tell you, this year has been one of our best years ever. What's amazing about the opportunity is with all these people that are safer at home, you know, quote unquote, you know, you're able to get a hold of them. People that would constantly reschedule, people that you could never get a hold of, now you can get a hold of all of them. And they typically keep their appointments because they're not running late, because they're coming home from work late. They could just put pause on the computer and now have that conference with you. So I see this as a tremendous opportunity. And one thing we're going to start doing is all clients going forward are going to be given the option. Do you want to come in the office or do you want to meet by video teleconference? And I'll tell you, for clients where both spouses work, you know, one might be running late and all of a sudden you got to reschedule because you can't have them both in there. That's a tremendous opportunity now. And I see that's going to expand my ability to not be stuck at the office and can handle a lot more by having that opportunity there. The other thing that I would say is with the market being down, all the more reason to look at Roth conversions for your clients. We have the lowest tax rates that any of your clients have ever paid as long as they've been working. And you look, I don't know how many of you know what the Democratic proposals were of all the candidates. Well, now we don't need to know all of them because it looks like Biden is the guy that's going to be running on the Democratic side. Top federal rate, he's talking about taking us back to the 70s with a 70% top federal rate. Okay, well, that's almost double what it is. But what if we have, you know, and that was before the coronavirus that was proposed, by the way. So we're only spending maybe an extra 10 or 12 trillion, no big deal. But that'll probably have an impact on what they're proposing. And when I tell clients about that, I'll say, well, before you think it's unprecedented, in the 70s, we had a 70% rate, but that wasn't the highest rate. Do you know what it was and when it was? Now, a single client can answer. Well, it was 94% back after World War II. Now, they did something then, in addition to raising the taxes, they dramatically cut spending. Have we ever cut spending? We've been at war for almost 20 years. We've never cut spending. And now we have the stimulus package spending trillions and trillions of dollars we do not have. So right now we have an opportunity while the taxes are low, your accounts are down. Let's take those lemons and let's make some sweet lemonade with it. And, you know, I'll just share one client, and you need to work with their CPA to figure it out. But what we're looking at, I tell them that, number one, if Trump gets reelected, the tax rates might be safe till through 26. But we know for a fact they're going up. It doesn't take an act of Congress, doesn't take a presidential signature. It's going up no matter what in 2027. But the Democrats have said if they get in office, the first order of business is to repeal the tax cuts. And then you just got to look at what their proposals are, kind of have an idea of where they're going. So I look at it, we talk about it with the accountant, and we come up with a strategy to convert. And no two client situations are alike. So you can't look at this as one size fits all. But we had a client not so long ago where we did a conversion. We were looking at converting $750,000. And by the time the conversions were done, and a lot of times what we do is we delay the bigger Social Security check. So obviously they're maxing out on taxes on Social Security for the spouse with the lower check while we're bridging to age 70, or we can max out on the Social Security check. And we literally got it where it's all converted, and we were able to make it that their Social Security wasn't taxable from age 70 on. So it goes beyond paying the taxes at a low rate. It's all these stealth taxes, like higher Medicare premiums and the taxes on Social Security, that you can really put them in a financially solid position. You know, and there's another way to get taxes paid on the IRAs, and that's buy life insurance for it. Now, you can do the conversions and buy life insurance to replace the money that was lost, and now you can define that. But if they're going to buy life insurance and kick the can down the road to pay the taxes, what are you going to budget for? 70%, 80%? You know, many of you probably don't remember the days where if you had too much money in a 401k, there was a 15% surtax on top of all the other income taxes. So I will tell you, there's been a common theme. I think everybody here has mentioned the word taxes, and that is something that gets everybody's attention. That's something we can control. We can't control the market, so let's control what we can. And the last point I'll make, and I've mentioned this before on the program, the House version of the bill, that is our new tax law, and the House version did not pass. They said no more Roth conversions. Second point is this new rules that went into effect with the Secure Act said that all IRAs for non-spousal beneficiaries and as well tax-deferred annuities, the maximum you can stretch now is 10 years. Well, there was proposals to do 5 years. There was 10 years with a lump sum over 450, and they kind of settled on a more soft version, which we can spread it out over 10 years. Well, what's going to happen now that the camel has his nose under the tent? I truly believe by the time your panel leaves this earth that we're going to have lump sum distributions for non-spousal beneficiaries. So what does that mean? For most Americans, their retirement accounts are their biggest accounts. Can you imagine the impact if there's a 70% top federal rate, and for those of us fortunate enough to live in a state where we get to pay state income tax, here in Wisconsin, it's roughly another 7%. So you're talking 77%, and let's say they bring back that 15% surtax, it could literally just wipe out the IRAs. And, it wasn't so long ago that there was enough money in retirement accounts to pay off the federal debt. Now we're behind that. And dead people don't complain. They don't vote. And if the beneficiaries complain, they're looked at as greedy because it's not their money. Well, do they really deserve that? So we can really do our families a huge justice. And then the opportunity that's there, if you do all this, you have a family meeting and discuss it with the kids and let them know what a wonderful advisor you are to the parents and how much of a difference you're going to make for them when they eventually inherit this money. So it is, I agree with Van. There's never been a better opportunity to be in the business and take that to the next level. There are so many people running and hiding. And if you look at us, we're all baby boomers or older. A lot of us are going to have to retire someday. But imagine all the ones that are running and hiding that are just going to say, you know what, enough is enough. I'm done with this. And you combine that with the new regulations that are coming in June 1st with the best interest, I think a lot of people are going to leave the business. Imagine what an opportunity is right now. You should be able to buy those businesses as those people get out at pennies on the dollar. And because they're running and hiding, their clients have never been told, the right way to plan for these kind of things. And you're going to be a breath of fresh air, and the opportunities of really capturing a lot of new business from that existing business. I just think get ready for opportunities of a lifetime, and don't wait. This is an opportunity that doesn't happen very often.
Awesome. Michael, do you have any follow-up comments on that? And also, what is the American College up to?
Well, let me just start out by saying very quickly that I agree that there has never been a better time to sit down with a client and think about what it means to protect their income in retirement against a worst case scenario. There's been some talk about the low interest rate environment and the impact that it has on things like the amount of income that you can get through an annuity. It's important to explain that actually now is the best time to buy an annuity, because the annuity offers you not just your money back on safe investments, it also offers you mortality credits on top of that. And mortality credits are actually more valuable in a low interest rate environment. You're going to be able to buy yourself even more income compared to buying safe income with bonds in a low interest rate environment. And it's also important to talk to your client about how much income they actually need in retirement. I don't think there's any more powerful question than how much do you need to live on in retirement. And that can initiate a conversation about how much guaranteed lifetime income you have, how much safe income you can generate from your bond investments. And I know Tom mentioned dividend stocks. There has never been a better time to discuss why dividend stocks are not a substitute for other forms of guaranteed income, because what you're going to continue to see throughout the rest of the year is companies cutting their dividend in the future. So let's think realistically about how to build a safe income plan. Clients are going to be receptive to it. They're going to be aware of stock market risk. And the other thing I think is unique about this opportunity is, yes, the stock market went down, but it went back up. So perhaps take a point in time in the past and look how much your clients had in stocks, say, 10 years ago, and then look how much they have in stocks right now, and ask the question, how much of these gains do you want to cash in on providing yourself a guaranteed base of income in retirement? I think framing it in terms of gains, because you have gained significantly in the stock market compared to where you were, say, 10 years ago, at least framing those gains as an opportunity to build that base of income, I think, is an important way of reframing the conversation about your investment in retirement. Finally, what is the American College doing these days? If you've kept up with what's going on at the American College, we've developed a retirement income certified professional program. And I think there's no better time than now to bone up on your knowledge. We've also developed a new wealth management certified professional program, all delivered online, mainly through video format. It's a great way, if you have, say, an extra half hour during the day, to be able to develop your skills in putting together more complex planning strategies that are going to give your client confidence in your ability to put something together. I mean, just listening to Jim talk about some of the strategies that you can implement right now. Your income is down this year. Let's do a Roth conversion, especially if you're a small business owner. Understanding how to do some of these more complex tax strategies has never been more valuable.
Awesome. All right, I have a few announcements before we get to questions. Just so you all know, we have the full panel until about noon, and then after that, a lot of them are able to stay for a little bit longer if questions keep coming in. I know we've gotten quite a few. So a few announcements just to make sure you're all aware of what we do here at Real Wealth, because we have a ton of ways that we are supporting you right now. So one is we put together this pandemic panel to make sure you have some positive things to work with during the pandemic, instead of reading the news and being all stressed all the time like everybody else. We want to make sure that you're out there fighting the good fight with your clients. So thank you for coming on this session. We do have sessions every single month. So we are Power Session Live. Our parent company is Real Wealth Marketing. So we put on these sessions every month, and we're doing a bonus session in about 2 weeks on what's going on with the PPP and mortgages. We have two specialists on that.
And I just want to mention, for those of you that aren't aware, banks are literally closing their doors to new loans, whether it's mortgages or not. And we had Brian Wickert, he owns a mortgage banking company that's a regional one, and we had him on as a guest recently, and he was sharing some of the challenges of getting mortgages closed today. And one of the new things that they're doing is right up to closing, they're asking people, have you had a change in your job scenario? So and if they have, the deal's done. There's nothing happening. And we'll also have Sandy Botkin in to talk about some of the issues with the PPP. For those of you that aren't aware of these programs, I've had probably 4 or 5 business owners. I called all my business owners when this came out and told them they needed to apply and they need to apply early. otherwise funds will run out and you're going to have to wait longer. So that's one that you're going to want to be part of. The other bonus session we're having is with Mark Eibel, and he's the client investment strategies, or he's in charge of client investment strategies at Russell, probably one of the largest money managers in the world. So he's going to give us what we can expect going forward. We thought this would be timely to get people up to date on that. So feel free to join those. And if we see some other opportunities that we want to not wait till the next month, we will be throwing in some extra bonus ones along the way.
Absolutely. And I will explain, we do have another marketing side of our program where we are educating our clients for you automatically. We have a drip tool that does everything. It's completely hands-free, but it's really good information that your clients need to hear. So, for example, all of those questions that Van was asking, we actually have a recorded podcast that can go out to your clients to kind of explain, put things into perspective and let them know about the opportunities. We're also having all of these guests on the podcast for your clients as well. It's pre-compliance approved. We do it for over 20 broker-dealers. We're friendly with about 80 broker-dealers. So we do compliance for you completely. So you can have this information going out and